Peace, everyone. We are live now. This is DJ Trust Fund Baby, and today we will be having a economics class. Well, I call it real finance with our local quant Jay Edwards. Some of you all who participated in Monday's class, you all got a introduction of what he's like and some of the information he deals with. So, without further ado, here is our good brother Jay Edwards.
Hello, everybody. How y'all doing today?
Hi, Jay. Doing great. Thank you. Happy to be here.
Thank you. I'm happy to be here as well. Everybody enjoying their Thursday?
Yes.
Yes, what about you?
I'm doing pretty well. So while I give everybody a bit more time and a few more minutes to kind of flow in, also hello to everybody on the replay as well, or who might be watching this asynchronously. But while I give everybody a chance to file in, I want to know, what are y'all looking to get from this class? Where do you feel like you might have blind spots, or maybe not even blind spots, but just want to know more about finance and investing?
Um, I can honestly say I never had a money education. I'm always feel like I'm trying to figure it out. And the last time I was in economics was in high school, and I skipped school that day. So, yeah, here I am. Now I'm ready to learn.
Okay, okay. Well, sometimes, having a clear slate is good because it keeps you from building bad habits or falling into the misconceptions. What about everybody else?
Okay. Hey, Mr. Edwards. I'm Dorothy. So, for me, I have my own bookkeeping and tax practice. So, I have an extensive accounting background, but I know nothing about the finance side of it. So, I'm just here to
Uh,
learn that side of it. So maybe that way I can see a better picture, of what's really going on. So yeah.
your accounting background will serve you well. There's going to be parts of this class that you really like. Um, what about everybody else? I see more people are coming in.
Ask him the question again, bro. Some of the other people came in.
Okay, yeah. So I just wanted to know, kind of like, where do you feel you're at with finance as far as your and investing, as far as your level of education or what you know about it? What are you hoping to get out of this class? Just a general background.
Well, for me, if nobody else wants to go, I'm actually interested to see some of the information that you'll be sharing with people because whether if it's through cryptocurrency or if it's just understanding like having a proper dialogue for how to understand more about finance, I'm interested in I don't, you know so much. I kind of want to see what you about to show people for real, bro.
Okay. So just to give y'all a primer on what this class will be about and what my goal is for this, I don't want it to strictly be an investment class. I want it to be something that you could take tangible use from it and apply it to other parts of your life and possibly influence not what you think, but kind of how you think. There's something that George Soros said, that investment is a philosophical pursuit. And it really is, just in the fact that a lot of your investment style and the way that you make money or the way that you approach markets is really based on how you see life in general. So I want to help people kind of overcome some of the common misconceptions, some of the things that are kind of predatory in the industry that can sometimes keep people away from making sound decisions, and really hone in on how you can practically apply these things to your life in more than just investing, but clearly in investing as well. So some of the things that I'm going to be going over the length of the course is things like I'm going to give you an overview of capital markets and how they work. And when I say capital markets, all a capital market is a market where you're essentially buying and selling money, or you're buying and selling assets in some way, shape, form, or fashion. So there's a few different markets. I want to go over those things as well. I want to go over statistical concepts as well.
I do have a question,
And
if it's okay.
mhm,
Or do you want us to hold questions till the end?
you can ask questions as you please.
So for the type of investments that you're talking about, because you pretty much just said investing money, what would be a good starter number for somebody, just if we're talking about the investment portion? Like, how much money would I need to do some of the investments that you're talking about on the minimum amount?
On the minimum amount, well, anything is better than nothing. So I would encourage people to start small. And really, I always encourage people to start off paper trading first. That way you can get used to, and paper trading is essentially using a demo account. That way you can get used to the effects of the market on your capital, and you could kind of get some of those kinks out before you're trading your own money. But you could start with really as low as $500 is about as low as I would take it, just because you don't want to be risking too much of your capital in one thing. Um, yeah, but with that being said,
Sorry, can I
my goal,
also I'm sorry. Can I answer
go
it like
ahead.
your first question?
Yes.
Yes, ma'am.
Yeah, so my goal to get out of this, so I'll be moving back with my parents soon. And I plan on like paying off like all my debt, like my credit card loan and my car loan, and then like just basically start saving all my money. But like I know even if I save money, like just having it sitting there is not really like growing it. So I do want to figure out ways to invest my money and to see it grow.
Okay, well, you're in the right place. Did anybody else that just got in want to also share some of their goals and expectations that they would like? I see some more people coming in.
Oh,
Peace to
brother,
the
look.
room.
Oh, go ahead, because I was about to say sometimes you gotta say their name directly. They be acting like they don't hear you.
Peace to the room. Peace to the room. Appreciate you bringing
Peace.
this energy to us this evening. Looking forward to your presentation. As Brother DJ said, I'm really interested in just kind of seeing what it is that you're going to bring to the table here. A lot of times when I attend classes, I usually rely on the information to kind of show me my weak points. I'm definitely not one that I consider to be financially literate, but the class usually the information based on how I process the information that usually helps me kind of find a starting point. And then a lot of times I can associate the information to things that I might already know in other areas. So that's kind of really what I'm hoping to gain is a better insight on where I should focus my particular energies as far as my financial education is concerned. And I do appreciate the opportunity to be here. I'm very appreciative of you having the class this evening.
Well, thank you, and it's good to have you here. So, was there anybody else that wanted to go?
Yeah, I like to also show my appreciation too, man. Because DJ said you his finance guy, and then the way that you was breaking down like that PDF that he had pulled up for the government website, and then explaining how the taxes work, I was like, oh yeah, I got to hear more about this. So just appreciate you taking your time out to teach us, man.
Thank you, thank you. So yeah, so my goal here is essentially to take a lot of the guesswork out of things for y'all, and for you to be able to know what you're doing, and also not be exposed in a way that a lot of people are exposed and just don't know. So I'm going to teach you how to protect your money, and then also how to grow your money safely And growing your money safely doesn't always mean that you have to just park it, in things that give you super low returns. There is a common saying that I do not agree with, that essentially, if you want good returns, you need a lot of risk. I do not agree with that. And the first rule in investing and in finance, the first rule to making money is protecting your money. Because if you lose half of your money, you have to double your money just to get back to where you started from. Just as an example. So, yeah, I'll be going over some different things here to kind of help further that. So the first place I wanted to start off was just explaining what capital markets are, the different types of markets, and the different types of opportunities that exist for somebody to invest. And also, I want to explain the difference between investment and speculation, and then the different types of investing as well. So I'll start with the difference between investing and speculation. Speculation is essentially when you're putting your money into assets or participating in capital markets with purely based on expectations of price movement or expectations of other things that aren't concrete or don't have backing to them per se. So for example, let's say your friend told you, hey, I just bought Bitcoin, for example. I just bought Bitcoin. It's going to go up. Right now it's at 95,000, but it's going to go to the moon. And you buy into it. That's speculation. Yes, the forming of a theory or conjecture without firm evidence. Perfect definition there. So now what investing is when you investing is essentially when you outlay your capital or you participate in capital markets based on some form of theory. Usually there's some type of underlying thing that's driving it. So either you're buying cash flows or you're selling cash flows or you're getting something tangible in return. Or even investing can sometimes be when you have a strong enough statistical relationship between things to the point where you can realistically have an expectation of what's going to happen. So it's very important to just know the difference of the two. Sometimes speculation isn't always bad, but it's important to know when you're speculating versus when you're investing so you could properly manage your risk. So capital markets are markets where you're essentially either buying or selling money, some form of cash flows, or an interest in something that generates one of those two things. That's usually what you're doing in capital markets. So some of the different type of capital markets we have are equities. Equities are when you're buying ownership or a representation of ownership in something. So this is stocks and things of that nature, common stock, preferred stock, restricted stock, et cetera, et cetera. And the role in that is essentially allowing companies to raise funds using the equity markets so that they can invest in growth. And then you receive your money back either through dividends or some form of capital appreciation. And all capital appreciation means is that when the value of something that you have goes up, your capital goes up with it. And capital is just another word for money in this context. Then we have fixed income, and these are debt instruments, right? So these are bonds or money market. And this is not to be confused with currencies, which is also a form of buying money, but fixed income essentially is very simple. You're buying and you're selling money. And what you're buying and selling, your return is, or your coupon is based on, your return or coupon is based on the pricing that what you're buying and selling generates. So for example, if I'm if I buy a treasury, for example, and the treasury has a 5% coupon or a 5% APY or whatever may have you, what I'm doing is I'm selling my money at 5% interest to them, to the government. Now, when I issue a bond, what I'm doing is I'm buying money. So when you take a loan, what you're doing is buying money. So fixed income, essentially, if you're buying bonds, you're selling your money. If you're selling bonds, you're buying money. So obviously, you want to buy low and sell high in whatever situation you're in, or the inverse, depending on what part of that relationship that you're in. So that's things like corporate bonds, government bonds, which are also sometimes known as municipal bonds, when you're dealing with it at a city, state, county level, etc. And then you may have government bonds or treasuries.
What is one of the easiest ways in order to purchase one of the municipal bonds or a government bond? And like, what would be like a base cost for one of those?
The base cost would be dependent on the unit of investment there, but you can buy bonds pretty much anywhere. A lot of the way that people buy bonds is you can go directly through your broker, like TD Ameritrade, which I think is now completely with Charles Schwab. Um, that's one way of doing it. A lot of ways that some people do it, like they'll get treasury bonds, but they'll get it as options, which I'll go into derivatives a bit more later. You can directly buy bonds as well. Like, for example, if somebody does a private placement memorandum, sometimes that's a way of buying bonds, depending on whether or not they're giving you debt or whether they're giving you actual stock. But a lot of bonds you can buy directly through brokers, including government and municipal bonds.
Okay, just because I'm gonna ask you before somebody else asks you. What about buying bonds through Treasury Direct?
Treasury Direct, those are usually treasuries that you're buying, which are forms of bonds. And yes, that can happen. And a lot of people do it as well. Treasuries are usually called risk-free bonds, or usually the 10-year treasury is called the risk-free rate. So a lot of times, and risk-free, the implication of risk-free is essentially the government is contractually obligated to pay it. Now, nothing is truly risk-free because governments can default, and they do default, which is something that I'll go into later when I talk about sovereign debt and sovereign bonds, probably in future classes. A lot of times with United States debt, they're called risk-free because the United States hasn't yet defaulted on any of its treasuries or bonds for reasons that I'll explain later. But it is something that can happen, so nothing is truly risk-free. And that specific risk that I'm referring to is called solvency risk. It's actually a combination of solvency risk, credit risk, and currency risk as well. But I'll be going later in this class deeper into the different forms of risk that people may or may not be aware of. So the next type of markets that we have are currency markets, right? So these are things, or also known as Forex, which is essentially where you're swapping or exchanging money in denominated in one currency for another currency. Cryptocurrencies typically fall under this. However, sometimes depending on whether or not depending on how it's promoted and marketed, they can sometimes be considered equities, and sometimes they have traits of fixed income as well. But typically, cryptocurrencies also fall into currency markets as well. And then we have derivative markets. So derivatives are simply any asset or anything that you trade in that's derived from the price of something else. And derivatives are usually used as a way of being able to create and control liquidity. And liquidity is basically just how available money is, or or in the context of trading, how easy it is to get in and out of a position based on how much money is in that specific market. So derivatives are usually used to create liquidity or manage liquidity. They're used to manage risk and also gain access to leverage as well.
I got hella questions. Like I said, y'all can ask questions too. Don't just let me be the only one. But
Go ahead.
if there was a liquidity percentage that you would want to maintain, what would you say that is?
It doesn't always quite work like that. Liquidity percentage, let me fix the terminology. I think what you're getting at is how much of your capital you would want to have available to you to make moves at any point in time. Is that what you're kind of getting at there?
Yeah.
Okay.
I'm just
So,
speaking.
yeah. So investing, we call that how much of your portfolio you want to have in cash or cash equivalents or highly liquid things. And it really depends on your risk portfolio, on your risk tolerance and your overall portfolio and your strategy. So a lot of times, like to give you an example, somebody that might have a fat tail strategy like Cornwall Capital, for example, where they're dealing with a lot of derivatives like long dated options, where they're able to get a lot of controlled leverage. A lot of times they'll have a large percentage of their portfolio in cash, like 50, sometimes 50 to 80%. Now, that's not typical of most people. I recommend usually being around 10 to 20%. That's where I keep it personally. But it's really dependent on your strategies and also your risk tolerance as well. And the main usage also of outside of speculation and investing for derivatives is also hedging, which is managing risk essentially. And that's what a lot of companies, well, pretty much all companies do that have some type of exposure to market assets or market dynamics in their day-to-day of business. So for example, McDonald's would be a heavy participator in the derivative markets, right? Because you're frying stuff in seed oils, right? So if I'm, just as an example, if we fry stuff in seed oils, a lot of times that means you have exposure to soybeans, because soybeans are a lot of times used to make soybean oil, which then is used to make the seed oil that they fry their food in. So if for whatever reason the price of soybeans shoots up by a lot, it could potentially be very dangerous or have a lot of adverse effects for McDonald's as a corporation, because now it's driving up the price of everything. So instead of having to constantly raise and lower their prices because they have exposure to a liquid market, they use derivatives in order to hedge against that risk and keep things level. This kind of avoids prices from being all over the place all the time. Another thing, as an example, is airlines. A lot of times they'll have heavy hedging positions in natural gas and oil for the same reason. Those are just common uses. Farmers use it a lot. Like let's say that I have a farming yield and I'm working on my crops essentially and I want to lock in my crop prices. I'll use commodities for that. And a lot of times it's in either futures or forwards. Commodities is another market as well. And commodities is essentially natural goods that are being sold. So that would include precious metals, energies, lumber, different food products, things like cows, sugar, um, soy, once again, or soybeans is a big thing, wheat, what else? Oil, gold, palladium, silver, etc., etc. So for derivatives, there's a few different types. So there's futures and forwards. Futures and forwards are essentially obligations or rights to buy or sell an asset at a set price in the future. Now, with futures, there's also something that most participants don't do, but you can do, which is called accepting delivery. So there are commodities, there are participants in the commodities markets that will actually receive delivery of these things based on the price that they negotiated. That is something that is common, depending on the level of the participant. But for most retail participants, and retail, when I say retail, I just mean your average day-to-day person that's participating in the market, they're usually not taking delivery. Then you have options, which is a right, but not an obligation to buy or sell something at a specific price. And usually you see options in fixed income, equity markets, and currency markets. There are some options for commodities, but usually they're derivatives of derivatives. They're derived from futures or forwards. And then there's swaps. And swaps are contracts where you to exchange cash flows. So for example, and I want to give you a good example of this here. Has anybody seen the movie The Big Short?
I have.
We're gonna have to. So we have a money movie list. We're gonna drop that into the community for y'all because me and Jay, we have certain movies that we've watched throughout time, like the movie about pi, about the it's about the tour, but it's about numbers and gematria, and also the movie 21. It's a few movies like Money Never Sleeps, On Wall Street. So I'm gonna make sure y'all get the list so y'all can watch that stuff. It do help with your financial education.
It does, because it just gives you a frame of context. I mean, obviously, some things are, dramatized because you have to make it entertaining. But yeah, it does really help. So to give you an example of swaps, of what swaps was, do you remember the two nerdy kids that went into the bank and everything, and they were trying to get a custom contract made to essentially
Yeah.
bet on the mortgage market going down? So that was Cornwall Capital. And they were not like quite as nerdy, like goofy as it was implied they were. They're actually very successful. But what they did was something called a credit default swap, which is essentially we believe that these people are going to default on this credit. And when I say credit, right, credit is another thing for fixed income. So we have private and public credit markets. But in this case, it was credit default swaps, and they were betting on people defaulting on their mortgage loans. So essentially what they were doing was they were selling this. They were selling it. This is also called shorting. When you sell something at a certain price because you believe the price is going to go down. Now, to close your position, You have to buy things back at the price that you believe is going to go at. You have to buy back what you sold, the notional value of what you sold. And when I say notional value, it means the exact amount. So, like for example, if I have $50, then the notional value of that is 50 USD. Now, if it goes up, if I short something at $50 and it goes down to $45, right? Let's say, for example, one share of Amazon costs $1. So I short 50 shares of Amazon. But then the value of those Amazon shares goes down to 50 cents. And I say, hey, I want to close my position. I still have to give you back these 50 shares of Amazon to close the position. But now when I give you back, or I buy to close the position, it's now worth $25. So I keep the $25 as my profit, but the notional value of that was the 50 shares or whatever may have you. So swaps is essentially exchanging those cash flows. So because they believe the cash flows were going to go down that much, that's why they were doing it. But swaps is a bit more advanced, so I'm not going to get too deep into it right now. And plus, the United States keeps you from buying stocks, any swaps, anyways, unless you have $30 million in net assets. So I don't think anybody, well, I don't want to project, but I don't think anybody has to immediately worry about that here. Did anybody have any questions so far before I move along?
If you don't, you take notes for later, but y'all for sure should ask questions. I'm telling you, ask questions. But go ahead, bro.
Okay. So with that being said, now I want to get into some of the parties that you'll see that participate in capital markets just overall. And so we have your central banks. That's things like the Federal Reserve or the United States Treasury. The ECB, which is the European Central Bank, the Japanese Ministry of Finance or the Bank of Japan, et cetera, et cetera. You have your central banks, and usually the central banks are the ones that are controlling monetary policy. Now, in certain places like the European Union, the individual countries will have central banks. However, a lot of the fiscal determination and a lot of the monetary policy, because they have to be pegged to the euro, is controlled by the European Central Bank.
So when you please express like why it's important to even have an understanding of these different entities, because like of what you showed the class on Monday and stuff, different ways you can leverage just understanding how the money flow.
So it's important to be aware of the different entities. One, because it's, to be quite frank, the game of finance is a nefarious game. So you need to know who you're dealing with, or as some people in the military call it, know your personnel, so you understand your rules of engagement. It's also important to be aware of that as well, because the market runs off of a lot of things, but the biggest thing that it runs off of is psychology. And you kind of need to anticipate what different market participants are doing so that you know how to protect your money, where you should be putting your money, et cetera, et cetera. But it's also important to be aware of what the central banks are doing, because something that a lot of people don't know is that most asset prices and most price discovery is driven by fiscal flows in one way or another. And fiscal flows is essentially the managing of the money supply through fiscal policy. So money typically money seeks to go certain places depending on the environment that the markets or the overall economy is in. So this can a lot of times we refer to this as risk on, risk off environments. So for example, in hard times, what do most people look to do? They look to save and protect their money and their resources, right? So when you look at money from a larger scale, risk off a lot of times comes from economics are in a rough place. So we're looking for risk off assets, safe places to park money. And usually when that happens, those risk off assets, because of supply and demand, they'll appreciate or go up. And then in times where maybe the risk off assets aren't doing enough, or in times where you have heavy inflation or just other things going on, money will seek risk on assets, which are things that can be more speculative. So we're thinking of stocks that might not be blue chip stocks like medium to small cap stocks. And when I say cap, what I mean is market capitalization. And all market capitalization is or market cap is the aggregate value or the overall value of all the individual pieces of an asset all added up. So to give you an example, right, when they say Apple is $1 trillion company, just as an example, what they're really measuring is market cap. So they're saying based on the outstanding shares, because just because it's $1 trillion company doesn't mean that to buy a share it's $1 trillion. So what that is the value of all the shares that are out there, all added together, comes to the value of the company. So when they talk about, for example, billionaires going up and going down, or billionaires, their wealth going so high up or gaining so much in these economic times, a lot of times that's due to the fact that we're in an inflationary environment. So assets tend to melt up or appreciate during early stages of an inflationary environment. So the total value of the company will go up. And because they'll have so much of this company's value, their wealth goes up with it. So just in as another example of liquidity as well, because liquidity within the personal finance context, just because it goes up doesn't mean that they're liquid. A lot of times people say cash is king or this, that, and the third. Really, liquidity is king. Somebody, to give you an example, Elon Musk is worth what, 400 billion, something like that, give or take. But so much of his money is locked up in illiquid assets or assets that he can't easily liquidate, that he doesn't have the same level of power as, say, or a Ken Griffin, who might be worth $40 billion, but
Okay,
it's $40 billion liquid.
I know this kind of may be off track, but let's just say if one of my personal goals as an individual was to increase my net worth, what things do I need to make sure are like publicly reported or that I acquired in order to build a net worth like a Bezos or a Musk or a Larry Fink? Because if I'm going to do it, I have to aim for the top people. I'm just utilizing them as examples.
So net worth is just a measurement of your assets, your net assets minus your liabilities. Um, so the things that you would want to do is really limit your liabilities and or things that take cash flow away from you and be in as much assets as possible. Now, the way that people that have a lot of assets access that money right? Because there's something called being asset rich and cash poor, which you don't want to be. So a way that these people may access that money is hypothecation. And all hypothecation is I'm offering something of value that I own as collateral to receive a loan against it so that I can go ahead and do what I need to do. And as long as I'm able to pay back this loan or service this loan, and all servicing a loan means is making your payments, as long as I'm able to pay back or service this loan, then I still keep the assets are still mine, but now I have access to that money. And when we talk about, so when I talk about liquid assets versus illiquid assets, right? Liquid assets are assets that, to give you the most textbook definition, they're assets that can be converted into cash or a cash equivalent within a 90-day period. That's typically considered a liquid asset. And when I say cash equivalents, that's things like certificates of deposit, money market funds, commercial funds, et cetera, or just straight cash. Stocks are considered liquid assets if they're publicly traded. Basically, if something is publicly traded, it's typically called a liquid asset or a liquid market. And then there's illiquid assets. And these are things that are a lot harder to buy or sell, usually because there's lockups or some other things. So like illiquid assets would be things like real estate or property. Um, Resource rights are liquid assets. Private credit and private equity. So this is essentially fixed income or equity deployments that are made through contract versus being done in a public exchange. And those things typically take longer to convert. Did anybody have any questions about that?
Yeah. So can you explain that hypothecation one more time? From what it sounds like, I might be mishearing you, but it's a process where you take your assets and you create a loan to yourself, or does it have to be to yourself?
It doesn't necessarily have to be to yourself, but it typically is though. But where you get a loan from another party and done to yourself. But there is hypothecation now through crypto, or also known as DeFi, where it's called permissionless, which is essentially as long as it's there and you maintain a certain amount of collateral, you can just get it whenever you want. But hypothecation is essentially when you take an existing asset or existing money and you use that as collateral or leverage to get more money. So essentially, you're kind of creating money in a way.
Appreciate it. That's what I was kind of thinking, but I was like, this process sounds wild. No, appreciate it.
Yes,
The creating
yes.
money. Wonder.
So to give you a bit more insight, so we went over central banks. Then you have depository institutions, right? These are the banks that everybody knows, usually the Bank of Americas, Chase, Wells Fargo, et cetera, or depository lending institutions is another word for it. And they accept deposits and make loans. And because they accept deposits and make loans, they have certain requirements and guidelines that they have to abide by, and certain assets that they have to have on their books in order to operate. So most banks that people think of are depository lending institutions. And then we have another type of bank that most people haven't heard of, and that's called a shadow bank. Shadow banks are typically your buy side institutions. and can sometimes also be your sell side institutions. And to make it real simple, buy side are usually the institutions that are participating in the buying and trading of assets, right? So they're not actively selling things to people. And then you have sell side institutions. Those are your investment banks, like your Goldman Sachs, um, private equity firms. A lot of times, like may do that as well. But yeah, you have your Goldman Sachs, sometimes KKR. But what they do, what buy side institution, not buy side, but sell side institutions do is a lot of times they take companies public, or they help companies raise capital or raise debt by selling it. So they'll create the actual assets, handle the paperwork and everything, and then they'll help them sell it or raise that capital. And then in exchange for doing that, they get a commission. But yeah, your shadow banks are typically your hedge funds, private equity firms. Private equity firms are firms that invest in invest in equities. And equities, just as a blanket term, when I say equities, think companies. They deal in companies that aren't publicly traded. So when we talk about private equity, that's places like Oliver Wyman, Blackstone, KKR, et cetera, et cetera. I could list them all day. But those would be your private equity firms. Then you have hedge funds, and there's different types of hedge funds. There's long, short hedge funds. You have a lot of times insurance companies could act as pseudo hedge funds depending on how it's set up. Like, for example, we'll do a case study on Warren Buffett and Berkshire Hathaway another time because it's very interesting. But buy side institutions are institutions that are not selling or helping companies go private or raise capital. What they're doing is they're just participants in the market essentially, but they're also called shadow banks because they don't have the same. They're not technically investment banks, and they're not technically depository lending institutions, and they don't have the same regulations and restrictions, but they can act, and a lot of times do act, in a lot of the functions that these banks will act in. Any questions so far before I continue?
Yeah, I was wondering, for the private equity firms, like what qualifies like an organization or business to become one of these? And could you give like more examples on how it would relate to someone who like just started out with a business, how they could benefit from them or anything like that?
So yeah, private equity is a blanket term. Private equity includes angel investors, venture capital, and then you actually have the typical private equity firms. A lot of times when people say private equity firms, they're really talking about LBO funds or leveraged buyout funds. And essentially what leveraged buyout funds do is they buy assets or companies using the debt or the assets on their books as the collateral. And then from there, they might make changes to the company, or they might sell off, or they might sometimes they load the company up on debt and then fold the company in. Sometimes they make changes in it and want the company to keep going. It depends on what type of fund it is and their approach. But the way that most people benefit from private equity firms is it's a way for people that might not otherwise have the capital to receive the capital in order to fund ideas. Otherwise, you would have to be extremely rich in order to get anything done in this country or any country. Now, what typically qualifies somebody to actually run a private equity firm, technically, one would have to have a Series 65, a Series 79, a Series 82 as the principal, sometimes a Series 7, 65, 66. Basically, you would need to have licenses depending on what role you play in the company to manage investment funds or manage a pooled investment vehicle, which is what it is, or a limited partnership. If you want to go into the technical um, legal classification of what the entities are, if you're actually selling the shares or selling participation in the private equity firm, which is raising the capital, you would need the proper licensure in order to do that. A lot of times, certain college degrees or having a CFA, I believe level 2 or level 3 could also help you skip the Series 79, 82 requirements, et cetera, et cetera. But it would essentially be having licenses and capital, long story short. And when it comes to capital, it's really the connections to raise that capital that would qualify somebody to. But the biggest benefits that they provide in the market is essentially being a way for non-publicly traded, because not everybody could go public. There's a lot of restrictions for a company to go public. So it's a way for them to get that capital in order to fund ideas or whatever may have you.
Jay, check your text messages.
Okay. Yeah, so with that being said, having gone over the participants in the market and kind of the different types of markets there are, what I really want to go into in upcoming classes, because I really wanted to give you an overview, is how do I make money from this now? Or how do I properly, or how do I use this knowledge to make something for myself based on that? And how can I do it reliably or dependably? And with that, I'll be showing you different things like the daily treasury statement, and also going over different things like correlation and causation and co-integration. And all those is nothing happens on an island by itself. So the relationships between things and the nature of those relationships gives you trading opportunities that are a lot of times dependable.
So instead of you looking for patterns the way how most people are taught when it comes to stock, you'll actually understand the cause and effect as to why it happens so that you can position yourself to actually see how to benefit from these situations.
Yes, instead of the technical analysis chart patterns where everybody's playing Bob Ross on the charts and effectively getting nothing done. It's actually funny because almost nobody that actually manages money uses technical analysis.
And it's crazy because that is common language when it comes to learning about stock or even when it comes to Forex. And once again, I said in the last class, if people aren't talking to you about this stuff and are talking to you about selling Forex, trading stock, trading cryptocurrency, they are not educated enough to actually be directing you. What they may possibly be lucky or have a slight understanding of how one particular thing may work. But it's a difference between having a good, strong foundation so that you can move all the way across the board.
Yes. And a lot of times what that comes down to is biases. A lot of people don't know that there's risk. Let me start here. Risk is quantifiable. If you are able to quantify, this is how actual firms raise money. If you're able to reliably quantify your risk, then you're able to get leverage because you're able to manage the leverage. Leverage is more money or borrowed money essentially because you're able to manage this leverage properly, right? When you're able to quantify your risk, you're able to raise more money from investors because you're able to say, hey, this is what things look like in the downturn. This is what you could expect to lose in a worst case scenario, or what your exposure is. This is what we can expect to gain. And that's very important because, to give you an example, right? Everybody likes playing the lottery. The reason the lottery works is because the risk is quantifiable. And they sell you they sell you the lottery ticket at a multiple of the risk. This is how a lot of people get screwed over in their day-to-day life because nobody's taught how statistics work, or if they are taught, they're taught in a way that's so over their head, like it doesn't really click. So because you're not able to do this, they're able to a lot of times dump bad assets on you, which is something that's very common. If you look at the
Literally, my
fall,
next question was about to be, I want you to talk about Bitcoin XRP and the speculation associated with it and the benefit of being knowledgeable and things like that, and also the downfall of only being partially knowledgeable and being an impossible investor.
so the downfall of not being aware of your risk is that you will get screwed and you're likely to lose your shirt, just to be quite frank. To give you an example, Lehman Brothers in the big real estate crash in 2006 that went on into 2008, they were found guilty of, and this is something that's very common, of recommending bad investments that they knew were bad investments because they had communications internally that these are bad investments, recommending them to people that might be in pension funds, right? They might have their pension with them, they might have their 401k. The financial advisors will recommend you bad assets. Another example, not being able to quantify risk. Everybody plays a lottery. You're statistically throwing your money away because they know the likelihood of you winning the lottery, right? So when they set the number of, oh, this is 300 million, big win, right? And then we're going to sell all these tickets. The price of the ticket is a multiple of the risk. So what knowing your risk does is allows you to price assets properly. So you're not overpaying or underpaying for assets. Or well, you want to underpay, so that you're not overpaying or being underpaid for your assets when you sell them. So to give an example with Bitcoin and just a few forms of risk that people might not be aware of. There's something called correlation. Correlation is the relationship between two things. A lot of times when we say something is correlated and truly correlated, it essentially means that they move together or they have some type of relationship with each other that makes it predictable. So for example, the S&P 500 and the daily treasury statement, net fiscal flows, for example, have a strong correlation. Why? Because the net fiscal flows are money going into the economy. When people have their retirement funds or their 401ks, pension funds, whatever may have you, or if they're buying ETFs, whatever they do, 9 times out of 10, it's either going into the S&P 500 directly or it's going into some company that's a part of the S&P 500. So it drives that. Now, that's a causative relationship. And this is where a lot of people get mixed up, is that there is an actual point, a point like a number, where things are attributable to chance or luck versus when it's an actual relationship. And a lot of times, the things that people are selling you are attributable to luck, or there's not an actual relationship there. So, just to give you an example, if I'm able to watch the daily treasury statement and watch the net fiscal flows, and I know that this has a causative or co-integrated relationship with the S&P 500, then I could say, hey, net fiscal flows went up. S&P is likely to go up. It has about a 90-day delay, give or take. Let me start buying options from now while it's still low because I know where it's going. Where it gets more advanced is when you get into things like factor investing. A lot of investors that actually make money, by the way, are not stock pickers because that is something that is attributable to chance. Unless you're able to be an activist investor where you're actually able to sit on the board and influence the decisions of these companies, 9 times out of 10 it's attributable to chance. So you might as well just throw shit at the wall and see what sticks. So what they'll do is they do factor investing where these specific factors, I'm playing off the relationship of these factors in order to make my money in a reliable way. So, for example, there's something called beta. Beta is a measurement of how something moves relative to a benchmark. So, using the S&P 500 as a benchmark, for example, Bitcoin is heavily correlated to the S&P 500. If you work a job in America, 9 times out of 10, that's one level of correlation with the S&P 500. So that's one level of exposure. Then you buy a house. The real estate market runs with the equities. That's another level of exposure, right? You have USD. The S&P 500 and USD are correlated. That's another level of exposure. Now you buy Bitcoin and you think, hey, I'm doing the thing with Bitcoin, I'm saving. That's another level of exposure. Now, the reason that Bitcoin moves the way that it does is because it has a lower market cap. And what you're dealing with is the law of diminishing returns. The law of diminishing returns basically means that the more of something that there is, the smaller the movements in it are relative to the value of it. So, for example, if I have $500 billion, it's a lot. Growing that 10% is making $50 billion. That's very different from having $50,000 and wanting to grow at 10%. Which do you think that you're more likely to be able to grow 10%? The 50,000. So where does beta come into all of that? Because the market cap is lower, meaning that there's less money overall in there, so there's more room to grow. The beta is stronger. And all beta is a measurement of is when something moves, how much does it move relative to the S&P 500 or relative to whatever benchmark there is. So somebody that's a factor investor, like for example, Jim Simons, a lot of quants, really quantitative finance in general is built on factor investing. Factor investing, I might be like, okay, I know how the S&P 500 is going to move. And I have this asset and I know which assets are correlated to it. So instead of me going directly into the S&P 500, why don't I find something that has stronger movement relative to it? Because then I make more on the same money. And I can do it more dependably. Just to give an example. And these are very useful things to know and be aware of. And I'll go into more detail in the further classes. This class was just meant to be an introductory primer. But even to show you how these skills translate outside of just investing. right? Because essentially what you're doing when you're in the markets is you're playing an arbitrage game. Arbitrage is basically the concept of buy low, sell high. The value between where you're at, where you have it at right now, or where it's at versus what you think the actual value is, a lot of time can be considered the arbitrage. So, and there's different forms of arbitrage. A lot of times it may also be referred to as alpha. That's not technically correct, but it can be practically correct sometimes. But to give you an example, Jeff Bezos was a quant. The whole story about I was poor and I started Amazon in my garage and da 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 da.
Yeah, tell them the truth because that man come for money, and a lot of people don't know that, and they be making it like everybody had a damn equal start or they got it out the mud. No, they got it out of red envelopes, like how the Asians give their family red envelopes full of money. That's how you got it.
Yeah, so Jeff Bezos started working for somebody named David Shaw, who was the founder of a quant firm called D.E. Shaw. D.E. Shaw currently has $60 billion in assets under management, or more than 60. I'm sorry, it has 65 billion. The 60 billion was as of December of 2022, 65 as of December 2024. But D.E. Shaw was one of the first quant firms. And all quant means is quant, it's short for quantitative. And what all it means is that you're able to quantify, or you're quantifying exactly what it is you're doing. So he worked directly for David Shaw, and when he went to start Amazon, and by the way, just to give you a clear example, it's common for quants to make $400,000 to $500,000 in base salary alone. 5, 6, 7, 10, $20 million bonuses are not unheard of. Sometimes
Man,
the
how long
managers,
did he hold that job down?
he was there for a hot minute, but the fact that he actually knew David Shaw himself to be able to personally ask for his blessing and advice before leaving, and the type of relationships that you just get working at a quant firm like that, suggests that he was very well in there and made a lot of money. Point is, nobody that's in that's a quant is starting that had a successful quant career like that is starting a company in their garage. It's just not happening. The amount of money that's flowing around. To give you an example, right? Because these are shadow banks now, and this is what buy side money looks like.
Oh, somebody asked, what is the benefit of having a shadow bank?
You get to do a lot of the things a normal bank could do without
All of
being
the red
beholden to
tape
anybody,
coming to the bank.
without all the red tape, without all the regulations. These are the most powerful people in the world. The people that run these banks. These are people that crash economies of whole countries if they desire to.
He like earlier, Jay explained what shorting is. Imagine having enough money to where you can short someone's company to the point where they have an understanding that you're not to be played with. That has happened several times. It has happened in
Yeah,
the
we could
crypto
put you out
market.
of business.
Yeah, like think Larry Fink did it to Warren Buffett before. So that also lets you know how much money Larry Fink has versus Warren Buffett. If he can short Warren Buffett.
To give you an example of the type of power somebody in the shadow bank could have. George Soros is known for the trade that broke the British pound. At this time, the British pound is one of the strongest currencies in the world. This man was able to single-handedly, or not completely single-handedly, but damn near single-handedly, move it off of the peg that it had and crash and crash the British pound. They said that that trade was the equivalent of going in every British citizen's pocket. Let me hold $10 in one trade. You might have somebody like Bill Ackman, which I'll get into talking your book and everything, and why you should not, you have to do your own research. You should not be watching the news media and everything because they will lie to you to get their money off. But to give you an example, right?
Uh,
Bill Ackman shorted the
Hold on,
market.
before you go into Bill Ackman, because I really need them to understand what you just said. You have to watch when people promote cryptocurrencies and other companies heavily, because all it does is posture them in a position to where they can bail out because you just invested in. It's like a switch. So I've watched it happen with multiple things. It's an easy way to get you interested to become an investor so that they can have an exit strategy. Just be
Yes,
mindful.
or have exit liquidity. That's what we call it. And oh, make no mistake, these people have no qualms about it. I've been in chats where people laugh about, yeah, they're suckers. I'm gonna pump this and I need. They call you exit liquidity. You're not even a person. It's you're the money. You're the bag holder that I need to get out of the position, or the proverbial. Not saying any of y'all specifically, but the proverbial sucker. And nobody wants to be a sucker. But to give you an example of that, right? Bill Ackman went on CNN, CNBC, et cetera, when the COVID thing happened, and he went crying on air about how there needs to be lockdowns and all of this stuff and blah blah blah. And everybody was like, yeah, and they all, oh, he's worked up and cares for the country so much. He had a $4 billion position already ready, short on the market, made billions, one fell swoop,
Based on
just
the
off
way
of that.
he influenced the market through a public interview.
Talking his book.
Even Elon Musk, he did it with GameStop and AMC. And
Tesla, Dogecoin,
yes, the Security Exchange Commission reached out to him and they told him he has to stop doing that.
but the SEC is essentially defamed because there is there's a pipeline between working for these shadow banks and being in the regulation for these shadow banks. So the SEC is not your friend, to be quite frank. Are there situations where occasionally they will do their job? Yes, but it's not common. So because to quote to quote Carl Icahn, if you want a friend on Wall Street, get a dog. Because the implication is if you're participating in the capital markets, you're a big boy or a big girl, it's your responsibility to know what you're getting yourself into.
Well, okay. So as we wrap up, because we broke an hour,
Mm-hmm.
and this was just an introduction to some of the things that Jay will be bringing to you all throughout his semester, and also as he's building out his community for his quant teachings and stuff like that. Just make sure y'all communicate with him in the school community. But is there anything that you wanted to leave with the people? And once again, there are some financial transitions that are happening this year, such as the ISO, and we have implementation of XRP, and just things to look out for. Not necessarily financial advice, but some things that you have looked at that you know that have good utility, like some of the conversations we have, like IOTA and stuff.
Yeah, so what's happening now, or what's really been happening since probably around 2013, but really kicking into force now, is the standard for cross-border payments, remittances, and just movement of large capital or movement of capital is changing. And with those changes, there is potential opportunity there. But basically, to make a long story short, ISO is basically the standard for communication between banks, or one of the standards for communication between banks. Now, what's happened, there's cross-border payments, right? Which is essentially like if I'm making payments to anybody, like you, anybody ever use Western Union or send money to family or somebody else overseas or whatever
Western
may have you?
Union,
Yes.
MoneyGram, all that stuff.
MoneyGram, all of that. So those things are cross-border payments and remittances. And the standard for that, the underlying standard for that is changing, especially on an institutional level, like between large institutions. And the Fedwire Fund Service is also changing over as well. And these are things that you can look at on the Federal Register. It's not just me just saying it, and things that have been worked on for a while. And hold on, let me pull it up.
You may have to send me the link because of the way you logged in. You may not be able to share screen. Or just drop it in the chat so I can open it up.
Okay. But basically what's happening is that the standards for these things are changing. And while it hasn't been explicitly said that it will be certain currencies or certain assets, there's only but so many that are compliant with where the standard is changing. And then when you look at who's on their board, who's invested in them, and who they have partnerships with, and the type of commitments that have been made over an extended period of time. By the way, I'll be sending notes out in a recap of this as well, where more links and materials will be included, and I'll be doing that after every class. But what's happening is that the standard for these things are changing, and there's but so many that are compliant with it. So you have places like Ripple, for example, or something like Ripple, the Ripple Ledger. It's compliant with the new standard ISO 20022, which they've been talking about making this transition. I first started seeing it in official documentation around 2017, but around 2021 is when I started noticing that they were having a lot of congressional meetings and Congress hearings. Meanwhile, mind you, while there's a whole case, this just goes to show you how dirty the game is. While there's a whole case that the SEC has against them, making it so that the average person has a lot of trouble buying it, institutional investors are buying in at low prices. And they're sitting with Congress and having congressional meetings about using it for this standard. A lot of the member institutions, a lot of the bank, I'm talking about just regular things. I'm talking about things like Department of Treasury in some cases, Bank of Japan, Bank of Switzerland, Bank of Spain, China. Yes, BRICS is included as well. As a matter of fact, I'll just pull up the ISO 20022 thing here, and I actually want you to share this on the screen just to give an example here. Just as a last thing, just because sometimes seeing things visually really helps kick things in, or like really helps like
I'm about to say you want to open up for a short Q&A for everybody, bro? Just in case
yeah, we could
anybody.
do it. Yeah, we could do a Q&A. But
All right. And before you do that, please tell everybody where they can find you before we start running through any questions anybody got for you.
yes, so you could find me at you can email me at jay.edwards edwards at puritas puritas.ai. You can also reach me at you can also reach me on Instagram as well. Let me go ahead and I'll post it in the school as well, but my at is j.edwards and then 2 underscores there. Um, you could also reach me in the school community as well. I'm the admin of the school community. You could DM me and I'll do my best to respond. But those are the main ways that you could reach me. But the main thing that I wanted to just get across there is that the standard is changing, and this is something that it's not just a single country thing, it's not just a single participant thing. This is something that the world has been working towards making happen. This is a lot of what the World Economic Forum is based upon, is changing in standards like this. This is what drives the Visa network and things like this. This is actually a reliable alternative to the Visa network. So what you have is a quadrillion-dollar market. And yes, I said quadrillion, meaning 1,000 trillion.
How many zeros is that?
A billion is 9. I think that's 15 zeros.
If it's a quintillion is 18 zeros. All right, bet.
So yeah, it's a quadrillion-dollar market. And when these things go out, these also extend banking services that might not have previously been available to places like Africa, South America, Central America, the Caribbean, certain parts of Asia, certain parts of the Middle East. It's faster and more reliable than the Visa network. So there's a lot of change that's coming along the way. And as far as the FedWire Fund Service moving over to ISO 20022 as the standard, it says directly on the website here, right? And this is also something that it had said when the publication or the minutes from the Federal Register of the actual meeting that they had with Congress came out, is March 10th, 2025. There will be a single day implementation strategy to adopt the ISO 20022 message format for the FedWire Fund Service. And there's a lot of countries that have already started adopting ISO 20022.
So let's do a quick Q&A. If anybody have any questions or if you have anything that you want to ask Jay, see if he has any programs or anything like that, feel free to come off mic so that you all can connect, please.
So, hi DJ, hi Jay, this is Bridget.
Peace. What's going on, Bridget?
Hey, Bridget.
I don't have a question really, but I just wanted to again thank you for doing this because, like I had said earlier, I never received a money education, and I'm always going after it. And when we shut down in COVID, I used that opportunity to get into real estate and put myself in the stock markets, and I made so many bad decisions, but I learned my way through it. And I could see myself in a lot of the different things you were going over tonight, even. So I'm just really excited to have an opportunity to work with you in my businesses and learn how to, move in this space as well. So really, that's it. So thank you.
Thank you, and I'm excited to teach you as well. Oh wow, it's going up still. Huh.
Yeah, when this started, Bitcoin was, I think it's gone up 2,000 and XRP's gone up like 8 cents. I heard about XRP when it was around 10 cents. And when it was around 30 cents, when the SEC got into it, I thought, oh, I could sell it and, who knows what it's going to happen, but who cares? I paid 10 cents for it. Like, seriously? And if the SEC is involved, that's probably a good reason to hold on to it. So I'm really glad at least I made a decision to buy. I have probably almost about 500 shares of XRP, which really isn't that much, but at least
You made
knowing now
10
that,
times your money.
yeah, something I did then, I was like, all right, at least I did something good through all that. So yeah, I learned how to use it in real estate and accept it in real estate. I'd love to do smart contracts. And are you in South Florida also?
Yes, I'm in Florida as well.
Yeah. Yeah. Okay, cool. Mhm.
I mean, we might have to meet up sometime. But and some of the things that I'll be going over in some of the future classes is practical ways that you can, because for example, like you leave your money in the bank, they might give you a fraction of a percent to maybe a couple percent on your dollar, but then they're making how much off of it? I'll show y'all some ways to make more on your money and have access to your money, have liquidity, and be able to hypothecate and be able to go ahead and do things without having to sell your assets, but then also make 10, 15, and this is not a promise, but just an example of things that are possible, 10, 15, 20% on your money without having to speculate and go into things crazily. As far as the type of programs that I offer, I mainly do consultations, one-on-one consultations, and also I do technology implementations as well, software development and things like that. To answer your question, just depending on each person's situation. So if y'all want help, that's definitely
Did you
something that we could
my
schedule a
bad,
time to get
I was
help with.
away from Mike. Did you see that they had asked what kind of programs do you offer specifically?
hmm So yeah,
Okay, cool.
I mainly do consultations, and then I do projects as well. I help people build projects on a case by case basis as well.
He also implements automations into people's business models in order to make it easier for you to be able to scale your model. I literally was speaking to one of the sisters who I'm happy that she came today. And I was explaining to her how it used to take me anywhere from 3 days to do certain things that could be done less than like pretty much in 30 seconds in my company now. So Jay was the one who helped me to do that. And it's something that can be done to anyone's business model, whether if that's a machine taking your phone calls, doing cold calls, running through emails, helping you in order to manage your documentation, your data input, even some of your social media posting. It's ways to build out all of that through machine learning and software. And that's another thing that Jay deals with. Even though I know it's not his favorite thing to do, but he
I
does it.
like
And
doing it.
it's not his favorite, but he does very well. Trust me. It's a time consuming
Investing is
business.
my favorite thing. It's
Yeah.
time consuming up front for me because I'm actually setting it up, but I do enjoy hearing the stories from people. Like when DJ was like, "Bro, you saved me so much time in my business. I'm able to give this time back to my kids. I'm able to invest and do other things and start other ventures that I would have never had the time to do before." Those are things that I like hearing. When somebody says, "I'm able to scale and make way more money now because I don't have so much bottlenecks, or I'm able to focus on what's important or do what I like to do in my business instead of being a slave to the business. Those are the type of things that I enjoy.
So if you all don't have any more questions for Jay, he will be releasing the schedule for his curriculum for when his classes will be in the community and also where everything will be at. So just be on the lookout for that. But do you all have any more questions? If not, I'm gonna end the stream and I'm gonna let y'all go on about y'all night.
Thank you for your time. Have a good night.
Thank you.
Thank you for you all supporting and coming to build with us.
Thank you. I really appreciate y'all showing up. I'll be posting notes and also some things like movies or videos that y'all can watch in the community as well. Books. One thing I will say, I do have 2 book recommendations if you can get them. These specific books are probably, and I'll probably post PDFs of them as well. But there's one book called The Shadow Banker's Secrets, by a good friend of mine at Adagio who helps people start and raise funds and whatnot. And there's another book called Practical Speculation, which is probably it's my favorite investment book of all time.
Type them in the chat so that I can post them in the public one.
Okay.
I do have another question. With the link that you sent with the community, is that something that we just like we have to sign up for and create a login, or?
Yeah, you have to make a login that way that because you have access to download stuff and everything in there. But that's a free community. It's just your personal login.
Okay, thank you.
Yes, yes, yes.
And to give you an insight onto who Victor Niederhofer is, one of the beautiful things about investing is that sometimes some of the best people in the world will write books that are actually pretty good, and you'll get like so much knowledge out there. I really look at it as their contribution to society. But Victor Niederhofer, to give you an example of who he is, he came up under George Soros, and he ran a fund of his own, and he's 2-time hedge fund manager of the year. One of the best people to learn from, not only because he's had great success, but also because he's blew up funds before. He's made mistakes, so you can learn what not to do and why not to do it from him as well.
Well, thank you. Well, I most definitely appreciate you coming on to the show, kicking it with everybody. Like I said, you've been a great support. And bro, once again, on behalf of Trust Fund Baby, I tell them everything. I thank you for sharing your time and your intellect with all of us, bro.
Thank you.
So, yeah, peace. I'm about to end the show.